Hello friends, so today we'll understand IAS-33, a standard which relates to EPS, earnings per share. What is EPS? EPS is a financial metrics that indicates the profitability of the company on per share basis. So EPS is further classified into basic EPS and diluted EPS. What is basic EPS? Basic EPS is a profitability indicator that helps the investors to understand the ability of the company to generate profits. Higher the basic EPS, higher the profitability. So, how do we arrive at basic EPS? Basic EPS is equal to the net profit or loss attributable to the equity shareholders of the company divided by the weighted average number of equity shares. So this formula will help us calculate the basic EPS of a company. So let's further dive into the numerator component of the formula, that is the net profit or loss attributable to the ordinary equity shareholders. How do we arrive at the net profit or loss attributable to equity shareholders? The profit or the loss that is earned by the company during the year, the figure is further deducted by the tax expenses. That is, the tax expense include the present as well as the current as well as the deferred taxes, and further deducting the preferred dividend. So these two components are deducted from the net profit to arrive at the net profit or loss that is attributable to equity shareholders. So this forms the numerator part of the formula. So let's further understand more on preferred dividend. Preferred dividend can be treated either as a financial liability or as an equity instrument depending upon the terms of the preferred stock. So if it is considered as a financial liability, then the preferred dividends will be treated as interest payments and will be deducted in the form of expenses from the profits. But if the preferred dividend is treated as an equity instrument, then furthermore we'll try to understand if it is cumulative or non-cumulative in nature. If it is cumulative, then the dividend is deducted if or not it is declared, but if it is non-cumulative, then the dividend is deducted only when declared. Let's understand the denominator component with an example. WANES, that is weighted average number of equity shares. So to calculate WANES, we will create 4 columns, or we can take into consideration these 4 components which will help us calculate veins. Block, the number of shares, number of months, so let's take an example that the company issued the shares from 1st of Jan till 31st of March worth 5 lakhs. Further, in the month of April, the period covering until 31st of December, it further issued 3 lakhs of shares. So we are going to take a cumulative figure here, that will be 5 plus 3, 8. So we will now calculate the number of months, that is 1st to 31st of March 3 months, 1st of April to 31st of December 9 months. Now let's calculate the fourth component or the fourth column, that is the product, which will be the total the product of the second and the third column, that is number of shares into number of months. 5 lakhs into 3 will give us 15 lakhs. 8 into 9, 72 lakhs. Total of 87 lakhs. And the total number of months will be 3 months plus 9 months will be equal to 12 months. Veins will be equal to 87 lakhs divided by 12. So help us know